Today on the program, report by Sustainable Energy for All indicates Africa has only 20% of financing for energy deficient nations. Ghana criticizes ethical cocoa programs and firms refusing to pay up. Plus, we'll look at South Africa as S&P prepares to release the country's credit ratings. Thank you for joining us and welcome to Business Incorporated. I'm Chimeze Obi Iwago. First, the intraday market numbers. Here in Africa, mixed sentiment was seen between Nigeria and South Africa. The NSE traded in the negative terrain, 0.25%, while the JSE index maintained a positive trend at 0.15%. Kenya closed on Thursday also with a negative index of 1.18%, and the Egyptian markets closed for the week on Thursday, shedding 0.83%. In the Middle East, markets are closed today, but ended Thursday's trading on a negative note. The Abu Dhabi index shed 0.78%, while Dubai's index closed negative by 0.34%. The Qatari index also had its share of losses, recording 1.37%, while Saudi Arabia's market closed at 1.37% down. In Asia, markets traded mixed on Friday as investors remained cautious over the short-term economic impact of the coronavirus as cases around the world continue to rise. Australia's benchmark ASX 200 slipped 0.12% to 6,539.20. The heavily weighted financial sub-index finished up 0.22%, while materials and energy sectors struggled for gains. The Nikkei 225 index in Japan fell 0.42% to 25,527.37, while the Topix index finished fractionally higher at 1,727 points. South Korea's Kospi index gained 0.24%. On the Chinese mainland, the Shanghai Composite rose 0.44% to 3,377 points. The Shenzhen Composite was up 0.6%, and the Shenzhen Component added 0.54%. In Hong Kong, the Hang Seng Index gained 0.33%. Okay, let's look at the UK now. Britain has wrapped up another month of record-breaking borrowing as the cost of the COVID-19 pandemic continues to mount. Let's bring in Juliana now from London. Good afternoon, Juliana. Well, the latest public finances just released show that the UK borrowed £22.3 billion in October to balance the books, around £10.8 billion more than a year ago. How sustainable is this rise in borrowing? Chancellor Sunak talked about putting the public finance on a sustainable path. How does he intend to do this, considering the challenges facing the government?
Well, unless he's offering me a job, I'm not sure how he intends to do it. But the question of whether or not it's sustainable, I think it is sustainable for now. I think that's the message really from the OECD, from the International Monetary Fund. They've asked governments, particularly governments in the West, to continue putting money into the public purse because people need to be able to survive. And that money, of course, is going straight back into the economy. But, you know, looking at next week and the public spending review, it's definitely a tricky outlook for the Chancellor, Rishi Sunak. I spoke this morning to Bissy about the speculation that public sector pay is likely to freeze. Public sector workers are the people who have really put themselves on the front line during the COVID pandemic. And we're expecting people who work within the NHS, teachers, police officers, to not get an increase on their pay. That shows the extent of how bad public debt in the UK is at the moment. October's figure, which you just mentioned, about £22.3 billion, that's actually a lot lower than what a lot of economists had expected in this country. And that's because we had just started seeing the economy start to tick again. A lot of the furlough scheme had decreased and things were getting back to normal. Of course, we're now back into a public lockdown. So, of course, we are going to start expecting this debt to rise more considerably. And again, yes, the Chancellor is going to look quite toughly at some of the measures, one of them being this public spending freeze, the other being, which we've also discussed, the capital gains tax. But, you know, again, going back to your question about sustainability, if you know, the Chancellor Sunak doesn't give the job retention scheme, if he doesn't start supporting businesses in their times of need, then the consequences for the UK economy are far worse than what we've seen already.
And on data front, despite the pandemic, UK retail sales kept rising in October, with some consumers starting their Christmas preparations early. It appears some people rushed to the shops with their Christmas lists before non-essential stores were ordered to close.
They did. It's been obviously a tough year for UK retail. Really, really tough year. Many of them had to close their door for 3 to 4 months, and they're closed now. But there are signs of improvement, and this 0.5% rise month on month is the 6th consecutive month of growth. Clothing sales, fashion are down. It's one of the only sectors that are down. But we are seeing a surge in online shopping. That's increased by about 51%. And you're right, a lot of economists that have been speaking to shops for some inside information, they are suggesting that many people have done their Christmas shopping a lot earlier. I think now we're really going to start looking at the next few months and how November's months are going to be. We have been seeing a really interesting sharp increase. We are going to possibly see a sharp decline because the stores are closed. We are seeing lots of increase as well in grocery spending, although the panic buying isn't as bad as what it was in February and March. People are still buying a lot more shopping, a lot more toilet rolls than they need to buy. And that's really helping with the upward trend. But what most people would expect when you hear the word retail is clothing. And we are seeing significantly the number falling. And even where there is a rise in clothing, they are on a lot more cheaper items such as loungewear and sleepwear, and not those high-flying items like those bling-bling tops and blazers we should be wearing about this time of the year, Chimi.
And of course, particularly for you and I, who are working even in the pandemic. Anyway, G20 meeting is this weekend. How will that shape events for next week?
It's likely to be a little bit flat. There has been some discussion about G20. Most of that is centred around CO2 emissions. The G20, just to remind our viewers, is a gathering of the 20 most advanced economies in the world. It includes the UK, most of the EU, and the US. And this year was the first year that an Arab nation was to be hosting it, and that's the Kingdom of Saudi Arabia. When it was announced last year, of course, they were expecting it to be a completely, 8-9-star pomp and ceremony event, really showing off some of the changes that Riyadh has made in evolving some of the pretty archaic traditionalist sides of the kingdom. That hasn't been the case, and I think for many observers, they're happy with that. They're not really happy with the fact that Saudi Arabia, with all of the human rights abuses up in the air, were hosting. Many pretty senior lawmakers across the world were asking governments to boycott in protest against the human rights abuses. But of course, COVID-19 has gripped the world, so nobody will be attending. It will all be remote. I'm sure not to the pleasant surprise of the Prince. But yes, so it's mainly going to be focused around CO2 emissions and, of course, COVID-19, which again is still going to push over 100 million people into extreme poverty. So that will be the discussion, and I'm sure it's not likely to move the markets. But let's have a quick look at the intraday numbers before I leave you. Pretty well in positive territory at intraday going into the weekend. The FTSE All-Share is up 0.58%. The FTSE 100 is up by 0.63%. And the FTSE 250 is up by 0.37%. In currencies, The British pound also up on the US dollar at intraday by 0.12%, up on the euro by 0.30%, and up on the Japanese yen by 0.20%, Jimmy.
Well, Juliana, while we wait to see what next week will hold, let's enjoy this weekend. So enjoy the weekend. And in Europe, stocks inched cautiously higher on Friday morning as investors monitored spiraling coronavirus cases around the world and conflicting prospects for U.S. fiscal and monetary stimulus. Let's make sense of all of these with Annette. Annette, good afternoon. EU leaders couldn't agree on a new budget and the special Corona Rescue Fund. Does that mean that the fiscal stimulus will not come for Europe?
Well, it doesn't really mean that it's all over already, but of course the political pressure is very high. So here in Europe, we have the rule or the principle of unanimity. That means that every single European state has to agree to the budget and also to the rescue fund. And what happens currently that there's a standoff between the European Union and Poland and Hungary, because Poland and Hungary do object to a new proposal that there is a rule of law element, meaning that if you want to have funds from the EU, you have to also accept the rule of law in your country. And that is a problem in Hungary and partially also in Poland. So that's why those two countries are not agreeing to the draft budget or the budget outline, and also not to the Corona Rescue Fund, which is desperately needed for the countries, especially Spain, Italy, who has been very badly affected by the Corona crisis. So essentially what's happened next is now a lot of backroom political meetings, I guess, even though it will most likely be virtual. And then there will be another leaders meeting in the second week of December. And that's the last moment that can actually agree on a budget and also the rescue fund for this year. And if they can't agree, then there's no budget from January onwards. And the European Union needs to live on an emergency budget, which of course has a lot less spending than the normal budget.
Now in the U.S., the future of the Fed's emergency lending facility is also in doubt as the U.S. Treasury Department wants to stop them. What does that tell you?
It's an interesting one because one would assume that the Federal Reserve, as most likely the world's biggest and most influential central bank, should be independent. But in the end, it's not, because the Treasury Department has to sign off on those special measures. And now what the Secretary General or the Treasury Secretary Steve Mnuchin was doing is to say to certain emergency lending programs from the Fed, they have to be stopped by the end of this year. This has to be seen though in the big political spat happening in the US right now, as there were Republicans pressing for less stimulus from the Fed, because there's always a concern that there's just too much stimulus and that the economy cannot do it on its own. So essentially what happens is that this part of these special lending programs have to stop, and that had direct effects on the markets, with stock futures actually tanking on that news, because clearly the Corona crisis is hitting the US economy still very hard. And just recently Jerome Powell, the president of the Federal Reserve, was warning that there are challenging months ahead. So there is a lot more need for stimulus.
Annette, we appreciate your time. It's always nice to have you on the show, and we look forward to having you more often on the show. In the meantime, send me well to Chelsea. Enjoy the weekend.
Thank you. Happy weekend.
A survey conducted by Bloomberg suggests South Africa could move towards an even deeper junk credit rating this week by losing the only stable outlook on its debt assessment. S&P Global Ratings will publish its credit rating for the country today, and many expect the rating agency to change its outlook to negative from stable. Meanwhile, Moody's Investor Service also expected to release its ratings today. may leave its assessment at one level below investment grade, and many don't see Fitch Ratings, which is at 2 levels into junk, downgrading this year. Let's talk to Chief Investment Officer at Makwe Fund Managers in South Africa, Makwe Masilela. Thank you very much, Mr. Masilela, for joining us on the program.
Pleasure, and good day to the viewers.
Now, S&P and Moody's are expected to announce their credit ratings for South Africa, but more than half of respondents in Bloomberg's survey see S&P lowering outlook. Is that what you see too?
There is that possibility. Remember, we've always been in trouble. Then COVID then exacerbated the situation. And unfortunately, the way the government expects to improve their financial position is working on something which seems impossible, that is trying to make sure that they cut the public wage bill. And we know that there's a court that's supposed to be making a ruling when it comes to the freezing of salaries in December. And so far, we know that the guys, especially the labor unions, are not too happy with that. And anyway, since it was announced sometime in February, when our finance minister was making a budget speech, I mean, then the union said, no ways, there's no way we'll be happy for you guys to be able to try to cut our wages or to try to freeze the salaries going forward. So the problem here is we're banking on something that is going to be very challenging for the government to be able to achieve. And yes, our economic growth is not looking okay. And we've got the obvious stuff that we've been complaining about, that is the supply of electricity. And the very same guys who are supplying us electricity, Eskom, they've got a huge debt which keeps on increasing. So it's just not looking okay. And you get more other state-owned enterprises that are also in trouble. As we are talking now, we've got challenges when it comes to our public broadcaster. They want to cut jobs, and we know for every rand that they earn, they spend 1 rand 10 cents. So that tells you that their situation is not looking okay. The farmers as well, we've got the land bank, which is supposed to be giving money to the farmers. Unfortunately, they cannot lend out now because they don't have the money. They're waiting for a bailout. So yes, that possibility exists.
Happens, that means the next move from S&P, which already assesses South Africa's foreign currency debt at 3 levels below investment grade, could be another downgrade. Does that worry you? Do you see a probability of a default?
I don't see a probability of a default, and I think maybe that is what is consoling us. Remember this, all the ratings, all it says is that you guys, you've got a higher chance of defaulting when it comes to a repayment. And as it stands now, our bonds continue to be attractive because we continue to offer attractive yields. Just a day before, we've seen the likes of China for the first time ever, borrowing at negative rates, because when you check at rates across Europe, they're either flat or negative. So guys who don't have an issue with a mandate that says, please don't invest in anything that is rated junk. So they will continue to come back into South Africa. Why? Because they're chasing the yield. So yes, we will continue to do that. And bearing in mind that we borrow almost 1.2 billion a day to be able to service our debt. So I don't see a chance of a default. Yes, we know our revenue collector agencies, South African Revenue Services, they expect to collect more than 300 billion less than anticipated. But I think it's warranted given what has been happening with the economy. But will we default? I don't think so. And hey, look at what is happening in the whole of Africa. It's only Zambia now that we've seen, that they had that kind of a situation. And even the likes of China itself, one of their developers, they're into trouble. They defaulted. But as South African government, will they not honor to make the repayments? I don't see that happening. Maybe not now.
Well, with Zambia defaulting, a lot of people believe that other African countries may follow suit. Anyway, Moody's, on the other hand, is expected to leave its assessment at 1 level below investment grade, and they don't see Fitch Ratings, which is at 2 levels into junk, downgrading this year. While this would please Finance Minister Tito Mboweni, the ratings outlook for next year will depend on the Treasury's ability to reduce spending, narrow the budget deficit, and bring down the debt growth trajectory. Now, do you see the government of Ramaphosa achieving this?
It's not going to be easy for them to do that because they've got a very serious challenge coming from the unions. And I think the unions are justified, you know. And the reason we are saying that, because here you are talking public sector workers, you know, they've got the biggest pension fund. And those are the guys, you know, who help the likes of Eskom. They own almost 90 billion of the 488 billion when it comes to Eskom debt. But when the companies or the SOEs are in trouble or other people, they always run to that pension fund that, please help us. So it means we have been very opportunistic. When we need them, we go and want to tap into their pension fund. But when we want to please the investors and the rating agencies, we also go to the guys. I don't think that's fair. Maybe what we should be doing, other than trying to implement all the structural reforms that we've been making noise about, is to try to increase productivity. And I think most people ignore that part, because those who are still fortunate to have jobs, please, if we pay you to work for 8 hours, please give us our 8 hours worth. And I think that's where you should start. And remember, the government role is just to create an environment that will enable investors to come and invest and create the necessary jobs. So up until we address the real serious issues, then yes, I don't see us improving anytime soon, bearing in mind that the global economy as it stands is not looking okay. Just yesterday, we got the likes of IMF warning us, as we know the G20 summit is starting this weekend, that they see a chance of the recovery not working out because of the resurgence of COVID-19. So we don't expect to see any fireworks anytime soon. But
All
yeah,
right.
it can only be done.
All right. Well, Mr. Masilila, it's always nice having you on the show. We appreciate your time always.
Pleasure.
And Sustainable Energy for All, a Vienna, Austria-based agency, says sub-Saharan Africa still receives woefully little of the financing needed to provide residential electricity, despite having the most people without access to power. While the region accounts for 70% of people living in high energy deficit countries, 14 of its least powered nations received less than a fifth of the $43.6 billion in electricity financing to high-impact countries in 2018. In Burkina Faso, Chad, Democratic Republic of Congo, Madagascar, Malawi, and Niger, less than 3 in 10 people have access to power, according to C4All. Even though about $41 billion in annual investment is required to provide residential electricity for everyone globally by 2030, only $16 billion was available as at 2018. And Ghana has criticized cocoa sustainability programs and companies that it said are backtracking on a pledge to pay more for beans than the world's second biggest producer. The programs, which allow traders to certify that the chocolate ingredient hasn't been grown in protected forests or using child labor, benefit less than 10% of the farming population. Ghana Cocoa Board Chief Executive Officer Joseph Bohan said at a virtual World Cocoa Foundation meeting on Thursday that a $400 a ton premium on cocoa beans introduced by the government to help support West African farmers is needed to complement the social programs. The comments represent the latest escalation in the dispute between the largest cocoa producing nations and some exporters who have resisted paying a separate premium due to slowing demand. And with that, we draw the curtain on today's edition of the program and, of course, for the week. Thank you for watching. I'm Chimize Obi Iwagu.